Hey guys, in this video, we're going to be going over 3 REITs that I've carefully selected that have very high quality fundamentals. And REITs are just dividend stocks where most of their assets are just real estate. And because of that, they have really high dividend yields. And I'm going to be showing you all the metrics you want to look at, like the price to AFFO, what is the dividend payout ratio, because that's the most important thing for a lot of these REITs. And this first REIT right here, you won't believe how impressive that it is. If it doesn't impress you, feel free to hit the dislike button, because check this out. You get a 4.5% dividend yield with this REIT right here. They're only a $5 billion company. The market cap is $5.5 billion, but look at this revenue growth. You know, that you typically don't see this for a REIT. Now, this is some impressive growth. The revenue is up 53% from the previous year, and the best part is actually the balance sheet. Their net debt to EBITDA is a 0.5. This is one of the most unleveraged balance sheets I've ever seen for a REIT. This is super impressive, and they're growing their assets. The revenue's growing, the profits are growing, and so is the dividend. Like I said, you get a 4.5% dividend yield. And you know, just for some comparison, their net debt to EBITDA is a 0.5 and Realty Income is a 4.5. And the next REIT we're actually going to be going over is Realty Income, because I also love them. But I just like putting that into perspective that they deserve the growth. I mean, they're well above their 2019 price. Let me show you a quick slide real quick. All right, so here's what CareTrust REIT actually is. They do skilled nursing facilities, assisted living facilities, and independent living facilities, and then they got campus. So they have 408 properties. And down here is what I really wanted to show you. Look at this debt to EBITDA. It's a 3.8%. I can't stress this. Like, that's the main highlight of this company right here. The FFO payout ratio, so the basically dividend payout ratio, is an 80%. They have 9 years of consecutive dividend increases, and their average yield of new investments since inception is an 8.8%. Top 2 best performing healthcare REIT by the last 12 months and 5-year on a total return basis. So that's what's really impressive. And check this out. They actually have a credit rating, BB plus stable from S&P Global, and Moody's Baa1 stable. So, and Fitch right here. So CareTrust also just acquired Care REIT. This is actually a UK listed REIT with 137 care homes. And here's some of the details of the transaction. But here's kind of the best part. There's a rising demand for care homes driven by an aging population and an increase for dementia and other care needs, which is really unfortunate, but it's true. And this is specifically for the UK elderly care market, because this is a UK REIT that they're acquiring. But it's cool that they're now going to have some international exposure. We can kind of see the UK care home capacity in beds, you know, the beds per 100K. So these are kind of some cool stats here. But anyway, this is a new acquisition that they did. I do like it's going to help out the growth even more. So anyway, let's go ahead and get into this next REIT, which is Realty Income. They actually pay a monthly dividend. All right, so this next REIT right here is one of the most popular REITs. It's Realty Income. They have a monster portfolio. They're worth $50 billion. They're in the S&P 500. They're a dividend aristocrat, which means they've been raising their dividend for over 25 years, never had to cut it once. That's because of their recession resilient triple net lease structure. So they just do a bunch of triple net leases. They've seen some incredible growth from like recent acquisitions. I mean, look at this kind of sales growth. But their investor presentation is what I really wanted to show you, and the dividend. As we know, this company pays you a monthly dividend. They pay you 26 cents every single month. And that is 80 cents a quarter. And check this out. Here's their most recent investor presentation. They had FFO of $1.06, so they could easily afford the dividend. That's like an 80% payout ratio, because the dividend cost 80 cents a quarter. This is $1.06. And check this out. This is the most important part. They remain confident in this guidance right here. AFFO per share of $4.22. Remember, the quarterly dividend cost, we'll call it 81 cents. We times that by 4. So $3.24 is how much the annual dividend payout is. And they're making it easy on a base case, $4.22. So yeah, Realty Income is crushing it. They even have room to raise their dividend if they wanted to. So here's kind of some of the highlights. Obviously, AAA or A rating from S&P Global and Moody's, the 7th largest global REIT. They have some international exposure too in the UK, yeah, over there in the EU, I think maybe too. But 658 monthly dividends declared, 110 consecutive increases, dividend aristocrats member. So yeah, this is just such a monster company. Yeah, here's their 2025 guidance. Let's see right here. I want to look at AFFO per share. So it looks like, yeah, they remain confident. Prior guidance, yeah, they kept their guidance of $4.22 of AFFO per share, which is honestly a great news. And honestly, we want to know, where does Realty Income's money actually come from? Well, check this out. This is really good. 10% of the whole business, their top annual based rent, sectors is the grocery stores. 10% of the whole business is grocery store leases. And then they're in convenience stores, 10%. Then the dollar stores, they actually used to have a lot more exposure to the dollar stores, but they've recently been lowering their exposure to the dollar stores and the drug stores, which is Walgreens. They have a lot of Walgreens. So yeah, if we go right here, and this is the most recent quarter. If we go back a couple quarters ago, I think Walgreens used to be the top tenant, but now it's 7-Eleven, which is, of course, a convenience store gas station. Then it's Dollar General, Walgreens, Dollar General, or Dollar Tree. Then they have a Wynn Resort, which is pretty cool. Lifetime Fitness. Lifetime Fitness is actually a publicly traded stock, and they're doing pretty decent, actually. Then there's FedEx. They're doing decent. So, yeah, Home Depot's a great company, Tractor Supply, great company. And look at this very high occupancy rate of their leases. I mean, check this out right here. In 29 or 2009, 2010, it dipped down to a 96. That's the big dip right here. Went to 96%. Right now in the most recent quarter, it's a 98.5%. It's in here 99% of 2022. So yeah, that's really impressive to see. And look at that. They have accretive releasing activity. So check this out. Their renewal recapture rate of 104%. I mean, this is some impressive numbers. So their leases are being released by the same person. That means their tenants are making money as well, which is a great sign. And remember, we were looking at that other healthcare REIT with the very low leverage. Well, Realty Income is a little bit leveraged. They have a lot of debt, but they're still getting a return on that money. So it's smart for them to have that debt. But check this out. Their net debt to annualized EBITDA is a 5.4x, when for that other company, it was like a 5% or something like that. So it is a little bit different, but look at this super strong balance sheet. One of 10 S&P 500 REITs with 2 A ratings. I think some of the other ones are like Prologis and Public Storage, which is pretty cool. But yeah, we can kind of see they have 94% fixed rate debt, which is pretty cool. So yeah, anyway, that was Realty Income. Here's another thing about REIT dividends that I think is important to know. If you own a qualified dividend and make under $48,000 a year, which is me, whenever I receive a qualified dividend, I actually pay 0% tax on it. But Realty Income does not pay out a qualified dividend. So they actually pay an ordinary dividend. And so if you're a single taxpayer, and you make under 48,000, that dividend for me is taxed at 12%, which still isn't even that much if I hold this in a taxable account. But if I hold this in a Roth IRA, like a Realty Income and a Roth IRA, I get that near 6% dividend yield tax-free every year. And some people are happy with like a 6-7% annual return from like the S&P 500. Well, you're guaranteed, well, not guaranteed, they could cut their dividend, but they've been raising it for 25 years, but basically almost guaranteed to get that from Realty Income. 6% a year. You just let that snowball compound in your Roth IRA or the taxable account, if you don't mind just paying 12% of that monthly dividend out, and if you hold it in taxable. And that's why I like qualified dividends so much. If you own a Mo Altria group and make under 48,000, that 7% dividend yield is tax free. That's what's so cool. And even if it's from 48,000 to 600,000, I love how this huge gap, it's a 15%. So anyway, that's one thing I like to get about tax here. But let's go look at the final dividend stock. This one right here is one of my favorite REITs of all time, a grocery store heavy REIT. Let's go check it out. Brixmor Property Group. All right, guys. So for this last REIT here, this is Brixmor Property Group, and I like these mid-cap REITs. Like this one is worth $8 billion. Like that's good enough size where they can maybe even be acquired by like a Realty Income or even a Berkshire Hathaway. Berkshire Hathaway just acquired their basically biggest competitor. It was Store Capital. They're a pure grocery store REIT, and so is this one right here. This is a grocery store REIT. They do open air properties. Like their main tenants, as we're about to look at, is like Kroger, Publix. They have a lot of revenue, 337 million of revenue, and the yield's pretty good here too, a 4.37% dividend yield here. But this one also has seen a lot of stock price appreciation. Like this one is well above what it was in 2019. It was 16 and now it's $26. But check out this slide from their investor presentation. You won't believe how impressive this is. All right, so here's their most recent investor presentation for quarter ended March 31st. Look at their annual dividend. It's $1.15 now, which is pretty cool. They're one of the largest open air retail landlords, which is pretty nice. And check this out, 81% of their annual based rent is derived from grocery anchored centers. So yeah, like I said, a grocery store heavy REIT right here, we can see their top retailers by annual base rent. TJX, their stock has been doing amazing. Kroger stock is doing great. Burlington has done pretty decent. Dollar Tree, and then there's Publix. I like to see that. Literally, let's see, 1.5% of their portfolio is in Publix, 32 stores. Weirdly, Ross Dress for Less, their stock has done pretty decent. Publix also has a stock, you're able to view it, but they're not publicly traded. Only like employees can get Publix stock. Five Below is pretty all right. Then they have Amazon Whole Foods, 18 Amazon Whole Foods. That's a great tenant. LA Fitness, some gyms, and PetSmart. So yeah, I like how diversified that they are. Percent leased, 94%. And they have a lot of these accretive reinvestments that they're doing to a lot of their properties. They give a lot of examples, like the expected net operating income yields on 9% from their investment here. We can also see another one that they do right here. And this is just really cool that they have these accretive reinvestments. They really fix up a lot of these properties. Like a lot of these look very nice quality. So I want to show you a bit more of their leverage ratio. So yeah, remember we just looked at Realty Income. Theirs was around a 5. So here's their net debt to EBITDA. It's a 5.5x, which is really similar to a Realty Income. 100% fixed rate debt, and they also have a credit rating, triple B from S&P Global and Moody's, Fitch. So yeah, that's what's pretty cool about this company right here. Another triple net lease properties, center specific art, which is pretty cool. They get the local community. They're helping out the community and stuff. So yeah, this is another great REIT that I really like. And they're really highly focused on the grocery store. So please, if you enjoyed this video, please drop a like for me. It would really mean a lot. And please subscribe and watch out my previous video up here. I just went over all stocks that I own. If you want to see every single stock that I own, all 40 of them, I definitely own too many. Please check out this video up here. I hope you have a fantastic rest of your day. My name is Nathan Robert. I'll see you in the next video. And also, please drop a like on the video for me.